Good morning, everybody, and welcome back to Schwab Coaching. It's our Monday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a beautiful sunny morning here in Denver, Colorado. Today, joined by my friend and Schwab Regional Investment Strategist, Jeffrey Abalos. Good morning, Jeffrey. How you doing, bud?
I am wonderful now that I am here with you, Kevin. Always great to be on your show. Thank you very much for happening. Glad to hear that everything is sunny and looking nice in Denver today.
Yeah, it's a good start. We've got a busy week on deck, as often the case here. Although, Jeff, last week it didn't quite materialize as a busy week per se. There wasn't a lot of catalyst opportunity in the marketplace, and yet the S&P 500 and Nasdaq still had a pretty decent week. This week that can change a little bit, though, couldn't it?
They can. We've got a couple things on deck that I think both you and I are going to be touching on during the show. But I was surprised. I love that you mentioned that. There was kind of almost like a melt up with the S&P 500 staying above that resistance line that I think a lot of traders out there are looking at, which I'm sure we'll get to during the show today.
That's right. That's the approach that we like here. So we'll kick things off quickly here, everybody. I'll remind you to follow us on X, and in that, I should point out, of course, we do have Cameron May joining us today in chat, so say hey to him. Followed Cameron and me on X. Cam is at Cameron May CS, and I am at Kevin Horner CS. We'll be happy to have your follow there. If you do follow us, of course, you can engage with us there as well. We'd love to hear from you. In replies to the tweets that we post, etc. So please choose to engage with us that way as well. Do also remember need to be following us on the Schwab YouTube coaching channel. Make sure that you are subscribed to things there, everybody, and accessing our archive frequently. I see a lot of familiar names in the chat this morning, so I'll just say happy Monday to all of you. Thank you, everyone, for being here. Remind you additionally that our conversation is exclusively for your information and your education. We do not make recommendations here. Any expression of opinion is subject to change without notice. We do talk a lot of trading, though, and a lot of technical analysis in this segment. Please continue to think about technical analysis as a complementary viewpoint to your fundamental research. We do think it's a piece of the puzzle, but not to be relied upon exclusively on its own. Of course, everything we cover here should be considered, like I said, informational and educational. Past performance is never a guarantee of future results. Now, if you are new to this particular segment, we do a market review starting broadly. We hit up the major indices. We look within the sectors of note, try to get an understanding of how money might be moving amongst these various 11 sectors in the U.S. market, do some trend analysis, and of course, in a day like today, there's going to be some stocks in the news, so we like to bring those notifications to you as well. So we'll look at some individual equities moving around today and perhaps why they might be moving around today. So with that, we'll kick off with a look, as we always do, with the S&P 500, Jeff. And I think as you teed us off right off the jump here, you mentioned the former resistance level coincident with the prior high, basically 5670 is my top white line in here, everybody. And that's the level that Jeff was mentioning that we've held. Not just held, Jeff, we haven't even really seen a true test. Tests generally are not going to just be intraday necessarily, but that's pretty much what we've had. We have maintained that 5670 breakout, haven't really shown a whole lot of weakness here. So it sure has the impression, if not the feeling, that that the shift that the FOMC made was significant enough to give credence to the idea that the S&P can maintain this broken level.
It looks a lot like that, Kevin. Yeah, the thing that surprised me, and maybe we can touch on some of the components in a little bit, but as I was rifling through, I always look at some of the bigger, heavier hitters that are contributing to the S&P 500's performance, like NVIDIA, Apple, Microsoft, Meta. When you're looking at those, you really start to wonder what is exactly causing the S&P 500 to continue this momentum higher, because you don't really see a whole heck of a lot of outperformance from those participants. Now, as we look at this chart, one of the things that I found notable during the experience last week was, like you said, it never really came down and touched and held on to that former resistance level, now potentially the new support. So I am a little bit curious, what happens if we do go down there? You generally, in my experience, and I think for a lot of traders, you generally don't see something hold above an old resistance line for 5, 6, 7 periods and then go back down below it. It does happen, though, as we've talked about and Kevin highlighted at the beginning of the show. Past performance is no guarantee of future results, but that still does happen. So that's something that I'm kind of keeping an eye on right now, Kevin. I'm curious for the traders out there, all of our viewers, everybody that's watching this morning, what do you think? I'm curious what all of you are thinking. Are we going to hold that line, or could this just be a near-term movement off of the Fed's notice, and then we might find ourselves back below that line, which would truly be incredible?
Yeah, well, Jeff, the reminder to me, I think, is when we break out, do we get an opportunity to start trending once more? The breakout tells us the opportunity for a continuation of the downtrend, the uptrend in this place is in place still. And we've basically been kind of in this lengthy consolidation, making higher lows along the way and not making a higher high until the news of the FOMC's decision hit. And now we have a breakout. So the question, I think, becomes, can we start trending from here? And if so, can we do so against a speedier moving average like the orange 20-day as opposed to the 50-day or the long 200-day? But look at how close we're getting with the 20. It's really slowly moving into that zone up there near 56.70. So we're about 50 points away from it in the value of the 20-day simple moving average here. But we can see that is melting higher the longer we stay above 56.70, of course, because we're starting to incorporate new trading sessions in that last 20 days that continue to be higher and higher. So, Jeff, I think we have an opportunity maybe to start seeing a bit of confluence come into play as potential short-run support. Now, we do know, like you said, that the longer we stay above a breakout, the more likely that breakout is to hold. But that doesn't mean we can't get some volatility and some weakness. And in this particular week, Jeff, with we have jobs data on deck. And one of the things you and I were talking about pre-show was how, like you said, last week kind of just melted higher, grinded higher, right? Because we didn't have any good reason to be going down. We didn't have any good data to suggest otherwise. And the market just kind of said, all right, we'll grind a little higher. But Jeff, now that inflation seemingly is slowing and cooling a bit, the detail we're watching now seems to be jobs. And jobs is a big detail for us in the health of the economy going forward now, Jeff. And that can be the catalyst that might give us some volatility this week.
Yeah, remember, the Fed has a dual mandate. One that has been heavily focused on is the inflation component. The other one, though, is the jobs numbers. And Powell has been highlighting that throughout a lot of his discussions and trying to kind of weave that into the narrative and let the public know that is also something that they're looking at. But I love that you're highlighting that now, Kevin. That first part, the inflation component, seems to be under control. They're very close to that 2% target. Now it's a matter of, can we continue to manufacture this soft landing while not messing up the jobs picture? So they are going to be looking at that. And we'll probably be seeing a lot more articles and discussion over the next couple of weeks and months on what's happening with the jobs numbers as opposed to what's happening with the inflation numbers, Kevin.
I totally agree. And Jeff, that's the thing. We have to think about broadly when we're paying attention to the market is expectation of how data is going to be perceived. And we can use that to our benefit, right? I mean, that's why in the last few weeks or the last few reports we've had on CPI and PPI, for example, we've seen the market move favorably on those reports because the expectation for cooling inflation comes through in the form of those data points. And then the market uses that as optimism. Well, now, if we're looking at jobs and we are seeing the softening of the labor market, it's what the Fed was trying to do, and yet that doesn't necessarily mean it's going to give us positive market reaction this potential week. So, Jeff, that's the picture we want to paint this week. If you're looking for a reason to anticipate some volatility, the jobs detail, the jobs reports can absolutely be a part of it. And Jeff, when you look at what's going on with the VIX, for example, the VIX is up a slight bit, but definitely up relative to where we have been as we meander and maintain this ledge below 18, which is still favorable for long equities, I think a lot of traders would suggest, Jeff. But if that does climb and start pushing over 19 and 20 and potentially as high as 21, things start to shift a little bit.
A little bit, yeah. Then you got some more information happening in the underlying current of the S&P 500. We did
Yep.
have a viewer that asked, Kevin, where do we find when the jobs numbers are going to be released in the thinkorswim platform? Can you help us with that?
Yeah, well, let's go to the calendar to start us off, everybody. So I'm going under Market Watch. You can go to Market Watch and then navigate to calendar, or you can hover over Market Watch and go straight to calendar. And we have headlined Econoday events exclusively here, everybody. So this is what you're looking for if you're trying to limit the amount of detail you're getting from the calendar. Show me only Econoday events. One other quick note here, everybody: if you're coming here and you're not seeing this detail immediately, make sure that you have this symbol thing empty. So you might want to click on this, the gear, and clear the filter out, because if you have this linked up, for example, with one of your charts or what have you, you might have Apple in here, and then all of a sudden you're going to say, Kevin, why am I not seeing anything? Well, it's because your system is the system's looking for Apple specifically. So clear the filter, kick out Apple, get everything back the way it's supposed to be, and then you should be in good shape. So there you go, everybody. We're looking at the JOLTS report coming out tomorrow at 8 Eastern. We've also got jobless claims later in the week. I said 8 Eastern. I meant 10 Eastern, 8 Mountain, 8 Eastern this Thursday coming up. And then, of course, retail sales and the employment situation broadly. The unemployment detail across the board this week, Jeff, is going to be perhaps the one thing that could give the market some hiccups.
Yeah, that's really the big thing, and I'm glad you highlighted that. You got 3 different days of numbers to parse through. We don't have a whole lot going on in the earnings component because earnings season, by all accounts, is over. So now it's okay. Well, where do we get the white noise from? And I love that you called this out. It's probably going to be from the job situation. Now, one of the things that I saw that the viewers commented on, we do have the longshoremen potentially having you never know how long it could go, but potentially an elongated opportunity to communicate with their employer. Maybe that's the way we try and put it. And we're trying to put it nicely. Yeah, that could have an impact on the perception of the market and what might happen with the jobs numbers. That could also play into what's going on with Starbucks, because remember, there is a unionization component with Starbucks right now. So there's a lot of job stuff that's coming out, Kevin. I really love that you highlighted that this morning.
Hey, Jeff, there's also a little note or a tip we could probably provide for our viewers here today, referencing the JOLTS report, like we said, coming out tomorrow at 10 Eastern, and what that might imply for us, and maybe we can give a little bit of additional education for our viewers as it relates to that. What can we also provide here in thinkorswim that's going to give traders and users a little bit of insight relative to the JOLTS report?
Well, the thing that I always like to go to, especially when it comes to JOLTS numbers, when it comes to unemployment, even when it comes to retail sales and housing numbers, if you go up on the very top of the platform, click on Analyze, there is a very cool subtab below there that is Economic Data. So here we're on the Fundamentals subtab. We'll click Economic Data. And then this will take us to a bevy of information that you have access to. Now, the JOLTS numbers is going to be on the second column, about 5 or 6 down. It'll say job openings and labor turnover, which is what JOLTS stands for. If you click on that, you notice towards the bottom, you've got some JOLTS numbers. So if you wanted to see a graph of what's happening, show me the trend. And a lot of us here on Trader Talk this morning, we are very big into what's happening with the trend. This is a way you can get some insights into that. So if you aren't yet familiar with this area of the platform, I strongly encourage you to check it out because there is a lot of great information in here.
So I can look at job openings, the levels, and the rates. I can be specific to total of the non-farm. Okay, so I can actually get down into actual trends and actual charts highlighting this. Okay, well, this makes it a little bit easier for someone like me who is a charts fan to actually get a little clarity from trend analysis here. Okay, so that makes some sense. And of course, I can use the back button and just start moving through. So these are the portions that fall within the JOLTS report that essentially are the bullet points that the Fed is utilizing when evaluating the health and strength of the overall U.S. labor market.
There you go. Yeah. And one viewer pointed out, really good call out, by the way. Thank you for that. These are still done by phone survey. So
Yeah.
to find out what's happening, they're still calling people's houses. I've listened to a couple of podcasts on how they do this and what the experience is like, and trying to make sure they keep somebody on the phone as long as they can to get the answers to these questions. Very, very intriguing. If you get the chance, check it out. There's some good information out there, and there are a couple of people that do these surveys that they've interviewed. Always very intriguing to see what happens behind the scenes, Kevin.
Always. All right, Jeff. Well, we always like to provide here a little bit of information, a further bit of education relative to the tools at your fingertips here, everybody. So hopefully that little discussion around the reports, how to get some additional detail here in Thinkorswim was helpful for you. Let's get back to what we do best. Let's talk about the NASDAQ here and the trend we're looking at. Now, we've been watching the uptrend. We've been watching the potential for a break to new highs. I'm going to zoom in, and you know what? I've got a lot of junk on here, historical levels and things we've been monitoring, but let's clear the drawing set and let's just make this a little easier to pay attention to, Jeff. If I was just going to give you first blush with the move we've seen off of our September low into where we are today, how might you look at what we see?
So the thing that's capturing my attention, if that's what we're going for, what the heck are you looking at right now? You've got the lower high that happened in August, August 20th or somewhere around there. So you have this nice come up, and then it stops. Now, here you have a lower high from the previous peak that happened back there in July. So that would give a lot of pause on what was happening in the NASDAQ. But then most recently, you have a pull up above that point. No, it's not a very strong one, only for a few days, but now look at us. Very similar to the S&P 500, except maybe just sped up a little bit more. We are right back to that old resistance level, which could potentially be our new support. So, Kevin, I think a lot of traders out there and a lot of investors might be looking to what happens this week on the NASDAQ to try to give some insights and a little bit of information forecasting on the S&P 500. Very, very weird time right now, because it's almost like, you really don't want to comment one way or the other because it's possibly a little bit too early to tell. So that's what's really captivating my attention. Sure, you've got the 20 going above the 50, a little bit of a bullish indicator, but boy, if it does not hold on to that potential support line, that could spell trouble for not only the NASDAQ, but the rest of the market. Now, that's what's on my purview. What are you looking at, my friend?
I largely see the same stuff. Obviously, we got a decent open in the sense that we didn't trade below the low we made on Friday. So the fact that we've held that ledge could very well be an actual short-term test of support here on the NASDAQ. 3 days above it. Obviously, moves beneath it get to be difficult to short-term digest. I would not look at the first 30 minutes here of a session, first 20 minutes, and say, all right, I clearly believe that this is going to be going higher from here. It's probably way too early to validate that just yet, as we often say, but we're going to pay attention to the low we made here over the last 3 days. So that low on our gap up day, 19,966. Yesterday, Friday, low 19,964, very consistent. Today's low 19,956. So we are all in that 10-point range on a 20,000-point level, mind you. Very tight support, okay? Now, moves through there, we have some gap zones to pay attention to. There's a ledge of support in here, perhaps right around this zone, Jeff, I would think, and maybe the 20-day moving average getting caught up in here. But we just got to keep an eye on some of these important levels. The real takeaway I think a lot of traders are noting is higher low, and the potential for a higher low as well on any potential pullback in here, everybody. So we've got something to keep an eye on, Jeff. But I think the intriguing aspect of the NASDAQ is maybe the relationship we've seen with the semiconductors, and the semis had a good week last week on the heels of Micron's report, and yet they found resistance here, Jeff. And you notice the pullback you've seen in the semis. The semis did not make a short-term higher high, everybody. They made a matching high and have pulled back so far. So, Jeff, as the NASDAQ go, I think a lot of traders would suggest as the NASDAQ's going to go, it's likely to be driven by the semiconductors.
Yeah. Hey, quick shout out to the viewer who asked this question. How does the last day of the quarter affect the trading? Is there usually more selling to take profits? This comes from the Trader's Almanac. It's not specific to the last day. That one I don't know off the top of my head, but I do know the last 3 to 4 days of the month are generally the weakest. The first 3 to 4 days are generally the strongest. Why is that? Because a lot of fund managers are selling out of positions towards the end of the month and then buying into new positions at the beginning of the month. Now, whether that plays out or not in a single day, that I have no idea off the top of my head, but wanted to make sure I got to that question there, Kevin.
Absolutely, always. That's why we keep an eye on things. We try to answer what we can to everybody. Hopefully, we are doing a good job of engaging with all of you. As you can see here, I think the takeaway, at least for now, is we don't necessarily know what's going to be going on between where we reside today, and the potential for near-term support could come into any one of those major moving averages. Notice they're really coming together really nicely, Jeff. We're getting a bit of confluence here on the semis with the shorter-term traders watching 20 days, maybe the 50-day moving average, and then that real nice long one, the 200-day, also coming into play here. So there's a bit of potential support for traders of multiple time frames right in this zone. Now, hopefully we don't see that zone, Jeff. The hope is we don't even come down to test it, but rather make a higher low through what's been going on of late, and maybe we'd see something aggressive like this hold, and then suddenly we're back through that 53.70 ledge on the semis, and then trending higher once more. But we haven't done it, and the reminder needs to be, I think, for a lot of traders, Jeff, we don't know what's coming. We just know how we want to act if we trade upward through a certain level or downward through a certain level.
Yeah, that's right. Plan your trade and trade your plan. You cannot control what the market does, but you can control your reaction to it. Good call out.
Yeah,
Hey,
very
Kev,
true.
question for you. One of the components a lot of people are looking at, and I thought we could kind of rifle through these 1, 2, 3 really fast. NVIDIA, Microsoft, Apple,
Sure.
some of the big companies that are leading the S&P 500 to maybe give us an indication of what might happen a little bit later with the technicals. So just curious, as always, what are some of the things that are capturing your attention when it comes to something like these companies?
Well, when you look at NVIDIA from the technical standpoint, I think it's safe to suggest it looks a lot like what we've seen with the SOX, although the difference here, Jeff, is there's a pretty clear downtrend line that remains active here, right? I mean, if I capture just the series of highs that we had in here, the breakout was not really valid, was it? That was a one-day move, and suddenly we're back beneath it. Now, that doesn't mean we couldn't real quickly be right back up above it, Jeff, but I think ultimately, if we haven't traded through 130 on the NVIDIA ledge there, I don't think you have a whole lot that suggests that this is primed and ready to get going. I'm not going to speak too much more than that. I mean, that's just basic trend detail. But we should point out, Jeff, in the headlines this morning, the Chinese government is stepping up their pressure on Chinese companies specifically. They want them to buy locally produced AI chips, not NVIDIA's AI chips, as part of a national effort to expand their semiconductor industry and to counter the potential U.S. or the existing U.S. sanctions, according to Bloomberg. So Chinese regulators have been discouraging companies from purchasing NVIDIA's H20 chips, and that's what's used to develop and run the AI models. So this policy has taken the form of guidance at this point. It is not currently an outright ban. So pay attention to that headline, everybody, because yes, that does pose headline risk as it relates to NVIDIA, Jeff. That's something we have to make sure we're watching.
Yeah, as the saying goes, news beats all. So you definitely want to be looking at that. Okay, so you got NVIDIA. What are you thinking on Apple? Anything that's jumping out to you as far as, I mean, I know they had their numbers come out, their initial numbers on the iPhone 16 sales. They were a little bit softer than what they were hoping for. But looking at the most recent movements, it seems like it is still holding fairly strong. Maybe not as high as that high that we hit back in July, but what's capturing your visuals?
Well, I think we got to monitor those tails, don't we? I mean, we retreated on one day right here. We got up there again about a week and a half ago, retreated. We're there today. Now it needs to be, hey, can we actually pop through? I mean, the ledge to which we rise and then continually get beaten back, that ledge needs to stand out. That again, I don't want to suggest that we can't move through there, but I do want to suggest that only with a move through there is it likely then to bring bullish traders into the mix, Jeff. And that important level is just about 233. So let's just point that out. Again, we don't try to forecast what's going to happen, just how we want to act when something does in fact occur. Now, we should also mention, Jeff, that according to JP Morgan, in week 3 of Apple's product availability tracker, delivery lead times are showing trends which will explain the weaker lead times for the Pro models in the initial weeks, as calling them essentially an aberration that is led by a combination of a better supply mix as well as a delay in the pickup in momentum from higher end consumers that are actually awaiting the deliverance of Apple Intelligence. So JP Morgan believes these lead times suggesting slower initial demand for the iPhone Pro models are starting to correct. And so that is a bit of a narrative that suggests perhaps that the negativity we've seen since the release details has actually been a little bit unfounded, is how I'm reading that. Is that how you would read that as well?
Yeah. So it says it's a little bit early. The weakness might not be elongated. This could be a potential turning point as folks are waiting for the new AI capabilities to come out. Okay, makes sense.
That's how I read it as well. You also mentioned Microsoft. Let's pop them up. I've also got a little bit of headline news there for you, everybody. So, Jeff, Microsoft looking a little bit different, but talk to me about what's gone on the last 2 weeks after that move out of what seemed to be a pretty decent pullback to an area of support, recapturing the 200-day moving average since then. That doesn't look nearly as rough as some of the other charts.
It doesn't. It got really messy for a little bit, didn't it? I mean, you were all over those moving averages, inside, outside, inside, moving all around them. Now it seems like it's found itself above all of them, which is a positive for the bulls out there. And that cool line that Kevin just put on the chart, probably suggesting there may be some near-term support. Kind of a very common theme during today's show, near-term potential support. So this pullback, though, recently has me a little bit concerned. The reason why, for those of you who would be bullish out there, is because notice all of that red, and then when you look down at the volume during that initial part of the red movement, you see some increases in the volume on those red days. If you're bullish, that is really not what you want to see. You want to see weakness. So moving down in the volume, thus giving non-confirmation or a divergence to that pullback. So a little bit concerning. Again, for a lot of it, it's possibly a wait and see moment for traders out there. Is this going to hold this level or is it not?
True, Jeff. Hey, I know we've done some individual equity review here. There's a few stocks we should probably just hit on from an upgrade standpoint.
Okay.
Just to give you guys some ideas as to what's been changing. So Disney was upgraded today by Seaport Research, upgrading to buy from neutral, new price target at 108. Citing, quote, better macroeconomic underpinnings to the story, end quote, is the thought process from Seaport. And you can see there's been a developing scenario there, Jeff. It's broken the downtrend. We had a slight bull flag situation that then last week broke out bullishly. So that might be turning a corner in the short run. But I'll remind you, we remain below the 200-day moving average. So inevitably, some traders are sure to point to that movement and the fact that we're below the 200 and say, yeah, I'll wait and see, even still, Jeff.
Yeah, wouldn't be surprised. So one of the things that we look at as market technicians is the psychology of what's happening in the market. That 100 coinciding with the 200 period simple moving average, I would not be surprised looking at the volume that increasing with increasing green volume, would not be surprised if this continues its run a little bit closer to that 100 level. What it does from there, who knows? But seeing the RSI, seeing the volume, and then seeing the psychology component in the price, that may suggest some more near-term bullishness as to what happens if it continues that run. Time will only tell.
That is true. Time will tell. Now, Jeff, there's a couple more that I thought we could bring up. One of them was
Okay.
offered up by Morgan Stanley, upgrading U.S. Bancorp to overweight from equal weight, new price target at 57, old at 54, saying the firm suggesting that a faster pace of interest rate cuts is positive for net interest margin at mid-cap banks and more mixed for large-cap banks. Hence the decision to upgrade U.S. Bancorp as opposed to your Bank Americas, your Cities, etc. Now, the pattern on this seems a little bit notable because we have been really broadly range bound here for the better part of the year. And yet we've got that recent 52-week high there, Jeff. I just feel like we should look at this on a weekly and see if we can learn anything. And I'll tell you what, trend analysis stands out here, doesn't it?
Yeah, look at that. You've drawn that line right there.
Right through here.
Yep.
And then an uptrend going here. So if we were just looking at this action over the last few months here, this year pretty much, doesn't this last 4 to 6 weeks really kind of highlight the potential to break here?
Yeah. Well, you notice too, a little bit of a foretell, that double top that happened back in, we'll call it December through April or so. You had a double top, but it did not come down nearly as far as most double tops do. It found that support from its previous July high last year. The fact that it didn't come down much after that double top suggests that there might have been a lot more bullishness waiting on the sidelines for this particular organization. And now we're coming into that potential bullishness as we possibly hold above that level. I mean, gosh, like a lot of things today, it just seems to be, are we going to hold the support?
Yeah. Boy, that's kind of that just looks interesting. And you know, when you have a potential shift based on an analyst viewpoint along with a solid reasoning for it, I mean, that at least it's reasoning that makes sense, not to suggest that that's reasoning that you should be in it, nor that we could even achieve the price target of 57 which is offered by in this case by Morgan Stanley. But it is notable because that would be a tremendous move for the record, Jeff. We'd be looking at a better than 20% pop if it were to achieve such a level. I think there's a lot of traders who would tell you, even if we got a rally out of it, we probably need to watch former support near term as resistance here potentially first. And that's going to be about 54 and change. So that might be an area to monitor on any potential break. As would, Jeff, if we just evaluated it from the standpoint of the range we've traded in this year, it's basically been 39 to 45 or so. So that's about a 6-point range, right? And if we were just looking at it from that standpoint, everybody talking about a potential measured move calculation, we could just take that potential $6, add it to the level that we're breaking at 45, and it might give short-term traders a target at 51. That doesn't mean it has to be achieved, but that's a way that a trader might look at that and say, hey, if I could go from 45 to 51, take my 15% at 6 points and take a little bit off, they might choose to do just that. And of course, Jeff, there's also a little bit of that last level, again, at 50, potentially providing resistance as well. So remember, you know, we get these upside opportunities, but very commonly, Jeff, they do go a little more slowly than we traders want them to, right? They tend to do these stair-stepped approach, right?
Yeah, we want it to happen so quickly, don't we? It's like when you're listening to poetry and they're not rhyming the last words of the phrase, and you go, geez, just rhyme it already. It's the same thing for market technicians and those of us traders out there that are looking at charts. We think, just do what we were looking for. Just make it happen already. But unfortunately, that's not the way the markets are. Patience is a virtue.
That's hilarious. Okay, so while we're also talking upgrades, I thought we should make you aware of a couple of downgrades as well. Let's go back to my daily chart here. Morgan Stanley downgrading JP Morgan, JPM here on this. It did this to equal weight previously. We're at overweight, new target at 224, which is actually up from 220. Again, this goes back on what we just said relative to USB. So Morgan Stanley likes the mid-tier banks, dislikes the larger banks, stating here that a faster pace of interest rate cuts is positive for net interest margin at mid-cap banks, but mixed for the larger ones, hence the downgrade. Note again, downgrade to equal weight from overweight, not exactly a sell, Jeff.
Right. Yeah, and I mean, even looking at the chart, you're seeing some weakness, but I don't know that people would be able to say, well, there's a complete breakdown of confidence by the bullish side of this argument. Now, it is down a little bit this morning, almost 1%, but I think if we were to put something like an average true range on there, that's probably pretty normal for a JP Morgan. So I don't know that I would be too concerned by a headline risk on this position, only because, and I think this is most traders speaking when I say me, but the fact that JP Morgan is still kind of the big behemoth American bank makes it very, very difficult for, if something starts to shake out, that is almost your flight for safety. Jamie Dimon seems to have such a hand on what's going on in the political world, and it's just very, very difficult to say that, boy, JP Morgan is not going to be the one that comes out ahead if there were to be some sort of a shakeout in banks. I just don't know that that's enough reason for people to start saying, okay, I'm going to get away from this dividend paying company and I'm going to start looking at other ones. Who knows, of course. I'm just trying to speculate on what might be happening in the minds of other traders out there.
Yeah, I'm not sure how we're going to take that. Obviously, I think when you have a company that has done very, very well, you look at, for example, a year-to-date basis, just the 52-week low was 135. We ran to 225 for a 90-point move from the 135 area. That is not terrible. That's a nice, solid. I'm going to ballpark it to 60%, Jeff. But what is the number?
Yeah.
67% nearly there. And today to the level we're at, still from the 52-week low, better than 55.5%. So by no means a bad look, a bad run. Perhaps just the analysts doing a little bit of protection here, if you will, relative to the maneuver we've seen out of JPM. Now, Jeff, one other area for a downgrade today that I thought we should touch on is in Procter and Gamble. I was looking at the Staples. That's the healthcare. Let's see. I've got Staples in here somewhere. There it is. Staples have been going up quite nicely. Now we're in the midst of a consolidation here. Staples been getting a little bit of leadership as we've been rotating out, and I say out, but ultimately maintaining our technology levels, but not breaking back higher just yet, right? We looked at SOX, we looked at the NASDAQ, neither of which have actually quite broken to those highs like we'd like, but we've seen continued leadership out of Staples, out of utilities, out of real estate. That continues to look similar here. And yet today we had a downgrade on Procter & Gamble from Barclays, downgrading Procter & Gamble to equal weight. Had previously been at overweight. They left the price target at 163 on this, suggesting that Procter should continue to be considered a best-in-class operator among the broader global consumer staple sector here, but believes that it's outsized exposure to slower growth or declining markets, which would include China, is having an impact on their relative sales performance. So, Jeff, I read that as in a quarter-over-quarter, year-over-year viewpoint.
Yeah, I would also pick up the same thing. Before I comment on this, I just want to add, so I see one of the viewers in the chat, very funny comment, by the way. I do not take myself too seriously, so I love what you're saying. I am laughing along there with you. Thank you very much for posting that. But as it relates to Procter & Gamble, so you notice we've really given a lot of attention to the 20 period and the 50 period. If you look back in, call it late May, it broke below the 20, but nicely found that 50. And it just almost keeps coming back to find that 20 and then that 50 if it can't do that. So if you're a technical trader, this is probably very helpful for the bullish argument, both the article that Kevin just cited and what's happening on the chart. So very, very difficult, I think, to find a bearish viewpoint right now. But as we always say, we don't know what tomorrow is going to hold. Numbers do not lie. So it's very, very tough to say that, well, just because things are looking good today doesn't mean that they can't change a corner in a day or two. But from what I think a lot of traders are looking at right now, this is probably going to be a bullish narrative for the foreseeable future as opposed to a bearish augmentation.
Yeah, I'd be hard-pressed to disagree. Again, when we note that these are either upgrades or downgrades, these two on JP Morgan and PG are in fact downgrades, but they are to equal weighted on both. And, not all downgrades are created equally is the way I like to look at it, right? It's one thing to downgrade a company to sell. It's a whole different thing to take it from an overweight to an equal weight view. And the commentary further speaks to that, okay, it's had a good run and maybe the margins aren't going to be as great as they've been, hence our equal weight as opposed to now or what was a overweight viewpoint. So
Yeah.
again, don't try not to take that downgrade too negatively when you look at the trend analysis here. Now, under the 50-day moving average, Jeff, that could change quite a bit, but you're right.
Yeah.
Largely, this has been working quite well with the 50-day moving average. The 20-day has been quite porous in its opportunities to hold. If I removed the 20 here and just showed you the 50, it would sure seem like bouts beneath the 50-day have been buying opportunities in Procter & Gamble more so than breaks of the trend.
Mm-hmm. Really good call out, buddy. Good insight.
All right. Well, Jeff, as we often do, we run ourselves into time. So here, I will thank you for joining. Obviously, I know we've been across the gamut here today, to say the least. Got a little bit of red, but I'll be honest, everybody, the red is not really bleeding through maybe the way that some would have anticipated. Keeping an eye on that SOX today, as we are the weakest group there, off 1.1% amongst sectors and industries we monitor. So that's our leader to the downside here. And let's see if we can't maintain that short-term trend line or the levels that we were working with late last week here as short-run support. But that could tell us a little bit about our potential for the remainder of the day here, Jeff. So as a wrap up, was there anything you'd like to leave our viewers with today? So
I just want to say thank you all very much for your participation. Thank you for the comments. Thank you for the laughs. Thank you for the insights. It is all of you that make this show what it is, and I am always happy to be part of this experience. Kevin, as always, thank you very much for having me on today. Always a pleasure getting to collaborate with you, my friend.
Likewise, Jeffrey, always appreciate having you on, and big thanks to our man Cameron in the chat. Follow us on X, everybody, at Cameron May CS, at Kevin Horner CS, and big thanks to joining and participating today. We hope you all have a great Monday, everybody. We look forward to seeing you all again real soon.